Starbucks business model is in complete free fall right now, folks. They just reported an absolutely disastrous quarter. Stocks down over 12 percentage points after hours. AMD just came through with an insanely disappointing quarter. AMD has two business models inside the business that are in complete free fall right now. Supermicro stock is down over 10 percentage points after hours right now. Skyworks Solutions just reported an unbelievably disappointing guidance number that spells disaster for Apple stock. That stock's down about 10 percentage points after hours. The market was down 570 points in the Dow here today. NASDAQ was down over 2 percentage points. PayPal reported phenomenal earnings in that stock could only eke out a 1% gain here today. Amazon stock fell over 3 percentage points here today. They reported earnings after the bell. Very suspect. Right before the market closed, literally minutes before, Amazon stock magically all of a sudden just fell off a cliff within the last couple minutes of trading. Somebody knew something. Very suspect, okay? Amazon is up after hours, up about 1.7%. We have a lot to get into in this video here today, folks. A very, 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 very busy one. Starbucks. We got to talk about the disaster that's going on in Starbucks. Is this an economy-related things, or is this just Starbucks specific? We're going to talk about AMD and Supermicro. We're going to talk about Amazon and their earnings that just came out here. We're going to talk about if a disaster is coming for Apple on Thursday, because their earnings are coming out in less than 48 hours from now. And then we'll speak about PayPal and those earnings in depth, okay? I got a lot to get into in this one here today, folks. All I need from you, smash that like button. Make sure you subscribe. Let's freaking go, okay? Alrighty, so this is Starbucks. Complete and utter disaster. This might be the worst I've ever seen Starbucks business model, just to be quite frank, in my 15 plus years in the market, outside of Rona, obviously, right? When a lot of their locations were closed down or partially open and things like that. This is North America segment. Comp store sales down 3%. Change in transactions down a disastrous 7 percentage points, folks. 7 percentage points. Change in ticket was up 4%. So the amount of times basically people are going to Starbucks is going down massively. 7% decline is a disaster for Starbucks. And Starbucks is charging those customers more money, right? The store count for Starbucks was up about 3% year over year. Revenues for Starbucks were flat, which is not good, as technically they were down about, we call it a few $100,000. But when Starbucks revenues are down, when your store count's up 3%, that's not good. Operating income fell 6% for the company. Operating margin fell 110 basis points for the company. The international segment, even a bigger disaster. Comp store sales down 6% international, 3% transactions. I don't even understand how this happened for Starbucks. Check this out. This is insane. The ticket went down 3% for Starbucks. I don't even know how that's possible, considering we're in an inflationary environment and where they're going up on prices, and yet their ticket still fell year over year. Store count was up 9% for the company. Revenues were down 5%. So they had 9% more stores open, but yet their revenues down 5%. Disaster. Operating income, unbelievably disastrous, down 26% year over year for the company. Operating margins down a shocking 370 basis points for the company. This should never happen for Starbucks. Their revenue should be going up and up and up, year in and year out. Operating income, net income, this should be one of those stable business models that you don't really have to even worry about. Operating income falling 26%, unless it's like a once in a 100-year health event or something, right? Channel development segment results were disastrous. Revenue down 13%, operating income down 17%, operating margin down 280 basis points. This was a D-grade income statement out of Buc-ee's here, okay? I mean, if we look at company-operated stores, down 1.3%, licensed stores down 1.4%, other category down 10%, net revenues down about 2%, product and distribution costs, they did bring that down about 5.5%, so that was probably the only bright spot we can find in this entire income statement. Operating expenses were up considerably. Other operating expenses were up considerably. Depreciation and amortization was up 8.8% year over year. G&A was up 5.5% for the company year over year. Listen, if all your expenses are going up and up and up, and your revenues are going down, your profitability is going to get wrecked, right? That's exactly what we see. Operating income down a shocking 17.2% year over year for Buc-ee's. For Starbucks? No, flipping flapjack and way. Incredible. Look at net earnings attributable to shareholders down 15%. Net earnings on diluted basis, probably because they're buying back shares, I would guess, down about 14% for the company year over year. Oh my gosh. Now, first thing you got to ask yourself, is this just a Buc-ee's problem? Or is this like the economy? Like maybe, just maybe, the Fed lags are catching up. The consumer's been hit by inflation so far and so much that they can't even freaking afford to go to Starbucks anymore, right? It's a possibility. It's a possibility that maybe the consumer's been hit so heavily by inflation that they're even cutting back on the almighty Starbucks. The one thing that people thought no one could ever cut back. They're so addicted to those frappuccinos and those lattes and everything like that. There's no way they could cut back on that. And so that's a potential. And that's something we actually have to take serious, is that the consumer's getting hit that bad that even Buc-ee's is having trouble. But the thing I'll say, there's something going on that's much bigger here in my personal opinion, okay? And I called this out 5 years ago. Yes, I was 5 years ahead of the curve on this. And I talked about this subject 5 years ago, and I got a ton of hate at this particular time. And 5 years ago, I talked about Starbucks was starting to face serious competition, and this was going to be a huge long-term problem for the company. I was starting to see it on the West Coast, in Vegas and Arizona and other places, of a chain of locations called Dutch Bros, which is now a very known company 5+ years later, right? And if you look at Starbucks stock, it was just fascinating. I pulled up TradingView and I said, well, what's Starbucks stock 5 years ago? Starbucks stock was $77 5 years ago. Starbucks stock after hours right now is, guess what? $77. Isn't that fascinating? So that's an issue. There is actual serious competition for Starbucks. I see it all around me. Every other month, I feel like a new local little coffee shop opens up here. Plus Dutch Bros, a lot of these Dutch Bros locations, they've been expanding rapidly. They're right across the street many times from Starbucks. You're in direct competition. And when you're in direct competition and the consumer's been hit, that's tough. Really, really tough. Also suspicious. I've been getting emails, things from Uber Eats about buy one, get one free Starbucks drinks in the afternoon. Strange. I think they got another promotion going on Thursday. I'm like, when did Starbucks start doing buy one, get one free drinks? That's a little suspicious, right? Then I go ahead and take a look at the food items at Starbucks, right? And they started trying to take food serious about, I would say, I don't know, maybe what was it, 7 years ago, 10 years ago? But the problem is, and I think this is fixable if Starbucks actually wants to invest in their business, which I think they should during this time, they've got to take food more serious. This whole thing about we're going to open up a plastic sandwich and throw it in a glorified microwave for you and here you go for $7, $8, $10, whatever, it's not cutting the mustard. They've got to take things up to a higher level here. And I was just thinking, like, why can't they have 1 or 2 employees in each location just dedicated to making things like acai bowls and other simple items with fresh fruit, right? In the locations, I think it would sell phenomenal. If they actually had quality, good food products, I think average ticket would go up considerably for Starbucks. Instead of people looking at it as, I'm desperate to eat something real quick, let me get a Starbucks, they'd actually look forward to it. And then that would take Starbucks from being like, somebody goes and buys an $5, $6 drink, to then they're also buying a $10 food item. So now that customer, instead of spending $5.50 with you, is now spending $15.50 with you, right? There's a big difference in ASP there. Then you could also get these folks to, guess what? Maybe they go out of their way to get food rather than just they're going out of their way to get drink, right? And then that also increases their longer term business in terms of their afternoon business, which is, from what I'm hearing, very, very slow from the company. Instead of just counting on the people that are going to work at 7:30 a.m., you're also getting that person to come through at 1:30 in the afternoon who's hungry, right? So I think if they took food much more serious and got better quality and not just let's throw things in the microwave, I think they could actually build a really nice business around food and drink. I do not think drink's the problem for them. I think it's food is the issue for them. Now, is Starbucks a stock that potentially is going to be interesting to me as a buy? Let's say this baby keeps plummeting here. Yes, it would be interesting. But the one thing I'll got to say before I start a position in Buc-ee's here is I would have to listen to a conference call tonight, and I would have to walk away from that conference call confident that the current CEO of that company, really has a grasp on what's going on with the business and that these things are fixable, and that they can get revenue going back up in the right way and the profitability and those sorts of things. If I can walk away with that, then we can talk about this is a buyable dip opportunity. But I've got to hear that. And as of right now, there's a lot of stocks in the market that are calling my name, and this is just maybe potentially one of them. So right now, the stock is in complete free fall, and it deserves it, just to be honest. AMD Supermicro, then we'll get into Amazon, Apple, and PayPal. So this is looking at AMD. Now keep in mind, AMD is now a $255 billion market cap. It's literally one of the biggest companies in the world, right? The earnings put me to sleep. I couldn't believe it. I'm like, for a company that is this size and the stock price has gone up as much as it has over the last 12 to 18 months, you would think these earnings got to be a banger. No, sir. No, ma'am. Look at the revenues. Up 2%? Come on, man. Gross profit up 9%? What? Gross margins up three points? Okay, that's good. Operating income was impressive, up 125%, but it's a paltry $36 million. Who cares about $36 million operating income when you have a $255 billion market cap? There goes an Amazon Prime truck right there. It's one of those electric Rivian ones. That's horrible. Net income, $123 million? That's literally nothing when you're a $255 billion market cap. Literally nothing. These earnings put me to sleep for AMD. Now, AMD has two businesses that are red hot and two businesses that are a complete and utter disaster. The data center business is incredibly strong. That's up 80% year over year. Now, that's still kind of disappointing because when you look at the growth rates that NVIDIA has been putting up in 2023, those growth rates far more impressive than AMD's growth rates, okay? So it doesn't look like AMD is NVIDIA at the end of the day, right? Which doesn't come as a surprise to me, but comes as a surprise to other people. Client segment revenue up 85% year over year for the business. Very impressive, strong growth. And then they have two disasters. The gaming segment revenue was down 48% year over year. Oh, how's it even possible? Embedded segment down 46. Those businesses have been cut in half year over year. The gaming business and the embedded business cut in half? That's crazy talk. Now, I was asking chat on Twitter. I said, chat, what's going on with AMD's gaming business? And what I'm hearing, what people in the chat were saying, okay, they were saying basically they were saying actually three things. One is gaming's not that hot right now for PC gaming. And the second thing folks were saying was NVIDIA. And they were saying, if they've gotten anything or their friends have gotten anything, they've been getting NVIDIA chips for gaming rather than AMD. And the third thing I was hearing was people have just been sliced and diced by inflation. If you want to talk about who buys a lot of gaming equipment, it's a lot of the middle class or even under the middle class, a lot of younger folks. And obviously, slice and dice by inflation. And so there's just not as much money around to go spend, $1,000 or $2,000 or whatever on a gaming setup. You got to really watch your spending, especially on things that are, costing you money at the end of the day, because you spend time gaming. Okay, that's less time you can spend making money, right? So it actually takes a lot more money than you have. And believe me, like, I love to play games sometimes, not as much nowadays, right? But, it's an activity. It's kind of a zone out. It's fun, right? It's competitive, but it does take a lot of money from you. Not just a setup, but, it's taking time. You could be making money during that time, right? If you want to go play games for 3 hours, that's cool, but just understand it's costing you money. That's time you could spend looking into stocks, making money, driving, Uber Eats or DoorDash or Uber driving or, having a side business or whatever. And so there is a cost associated with that. And maybe that cost is just too heavy right now, right? And maybe it is a situation where people are having to get second and third jobs. And so they're like, dude, I just don't have time to game. Like, I'm trying to make it out here. I need to have some money to pay my bills. I need to have some money to invest, whatever. That could very well be the situation because the gaming segment for AMD it's a complete, utter disaster. No, when you look at the overall income statement here, I would give it a D plus overall, D plus. These numbers are not acceptable. For a $255 billion market cap, not acceptable. And these growth rates for revenue, honestly, aren't acceptable either for how big the company is and how much the stock has gone up. When it comes to Supermicro, they did have an impressive income statement here, but the one thing I'll push back on, if you look at their net sales, that was up we can call it about a 3x year over year. But look at the cost of sales. Cost of sales was up over 3x year over year. So your gross profit is, a very nice increase, but it's not nearly as much as you might have thought it would be, given the cost of sales also rose so much. They're also spending heavily on R&D, sales and marketing, general administrative. I understand that when you're growing your business the way you are, you got to spend on those things, right? So overall for the company, income went up substantially for them, about 4x year over year roughly. Net income was over a 4x for the company year over year, and EPS went to the moon. So good numbers out of Supermicro. I'd give them a B plus overall. Could it have been better? Sure. But overall, good numbers. Now, the stock's getting hit about 10% after hours, right? At the end of the day, a Supermicro, they have to come in with perfection. A B plus is not an A plus. There's a big difference between a B plus income statement and an A plus income statement. They need to come in with an A plus. And they came in with a B plus income statement, and so the stock's down 10% after hours, right? The stock's up 700% in the past year. You gotta come through with insane numbers. Let's get into Amazon, then we'll get into if there's a disaster coming for Apple, and then we'll get into PayPal, okay? So Amazon here, this is what an A plus income statement looks like, folks. Net product sales were up about $4 billion for the company year over year. Net service sales, which would be more like AWS and advertising, things like that, that was up for the company about $12 billion year over year. Total net sales was up roughly $16 billion year over year. Cost of sales, fulfillment, technology, and infrastructure, they kept all those line items in check very impressively. Very impressively. You look at the rate of growth in revenue and the rate of growth in those categories. They kept things in check very nicely. So total operating expenses went to $128 billion from $122.5 billion, so about a $5.5 billion raise. Well, here's the deal. Net sales was up about $16 billion, but your operating expenses only up about 5.5. Oh my gosh, you know what's going to happen to your flipping flapjack and operating income? It's going to go to the moon. Sure enough, operating income, Amazon Prime here for a delivery. All right, we're here, baby. $15.3 billion. $4.7 billion was their operating income this time last year. I should ask this guy, hey man, you own some Amazon stock or what's the dealio here? Now, check this out here. Other income expenses, right? This is more of a one-off category. They got hit by a $2.6 billion kind of more one-off here. Now, even with that one-off, they're still at about $13 billion in income before income taxes, right? So that's incredibly impressive. If they wouldn't have that one-off, you would have been looking at closer to, 15 billion, if not over 15 billion there. Net income for the company, over $10 billion of net income versus $3.1 billion in net income in the same quarter last year. And then look at diluted EPS, 98 cents versus 31 cents in the same quarter last year. I mean, guys, it's as good as it flipping flapjacking gets. Great work, Amazon. I knew it was going to be great. Sure enough, it was great. If you want to find any weakness here, okay, weaker guide. The guide was relatively weak, about, we can call it $146.5 billion at the midpoint for the guide, 7 to 11% growth, which would be down quite a bit from the growth rate in this last quarter. So could they be sandbagging? Knowing Amazon, probably. They do sandbag very often. That's nothing new to the company, right? But it could also be something that's maybe going on in the economy. It could be, seriously. You look at Meta. Meta had a little bit of a weaker guide as well. You look at some of these numbers out of somebody like a Starbucks. You look at AMD's gaming segment. And it's like maybe, just maybe, those Fed lags in inflation are really starting to take a hold. Maybe a recession's coming. I don't know. It's something you just got to consider. Something to be considered. Next up here, disaster coming for Apple. Then we'll get into PayPal. So this is bad. This is really bad, okay? For the June quarter, Skyworks gave their guidance, okay? They expect $900 million of revenue, plus or minus 2%. Now, just a number to always keep in mind, if Skyworks is ever doing less than $1 billion a quarter in revenue, no bueno. They're talking about $900 million. Analysts had Skyworks doing over $1 billion for this upcoming quarter. Those was analysts' expectations on average. Not even the bullshit analysts, that was just average. They're talking about $900 million. Where's their big weakness here? They say, we expect our mobile business to be down sequentially below normal seasonal patterns as excess inventory clears. That's basically the moral of the story is iPhone 15 is not selling. Skyworks' big customer is Apple. That's their biggest dog customer by a mile. Now, they also talk about in broad markets, we anticipate further modest growth. So this is way worse than it seems. The fact that they came in with this guide, because they're actually expecting in other businesses modest growth, but in their mobile business, that's a disaster. So iPhone 15 not selling well at all, which I told you guys it wasn't going to sell. I told you that like 6 months ago. Sure enough, that's a situation, right? Now, here's the deal in regards to Apple and how this affects Apple, right? Basically, there's no way Apple's meeting these analysts' expectations over the next couple quarters. Analysts had Apple growing about 1.5% next quarter. Probably not. They had them growing over 3% the following quarter. Probably not. Revenue is likely going to be the negative for this quarter they're about to report, then negative for the next quarter, and negative for the next quarter. Earnings per share. Analysts had earnings per share going up in the June quarter and then up again in the September quarter. I'm going to tell you guys right now, I don't think that's happening. I think Apple's EPS is going to go negative for the next several quarters. I understand they're always buying back a ton of shares, and so that helps them out. But I don't think they're going to be able to offset things with the revenue. Now, the question is, can Tim Cook keep the stock together? He's a pretty good pumper overall, I would call him. Maybe, he says AI and we're going to do this and we're going to do that. I don't know. I don't know what Tim Cook has to go off of. Because here's the thing. I don't think anybody's going to buy Apple as AI leader. They haven't been spending nearly aggressively enough. They haven't proven they can be innovative ever since Steve Jobs and Johnny Ive left the company. So I just don't see how they're going to convince everybody, we're going to be an AI play. So that's one thing that could keep the stock together. I don't know if people are going to buy that, just to be honest. What else are they going to say? Maybe next year's iPhone is going to sell well? Okay. They don't usually comment like that. That would be the ultimate pumper move if Tim Cook commented on that. The Mac business is blah. The iPad business is blah. The headphone business is blah. The watch business is decent, but that's also can be more of a discretionary spend sometimes. So we don't even know, if maybe some weakness is being seen there. The Vision Pro is, from what we're hearing, units are selling horrible, just as I told you guys they were going to. Way worse than Apple anticipated, and really anybody other than me. And so overall, no bueno. Does the stock crash? I don't know, because you got to understand, Apple stock is it's got a lot of long-term investors in it, the Buffett-type people. We know Apple's always buying back the stock, right? And so I don't know if the stock really crashes. It's not, even if their numbers are trash and they report big guide down on revenue and EPS, which they're probably going to do. Even if they do that, is the stock going to crash? Maybe not. Just because they got that shareholder base that's just like, they'll eat anything up, it seems like, right? So we'll see. We'll see what happens there. No bueno. Next up here, let's talk a little PayPal. So PayPal, very impressive numbers here. 14% total payment volume growth year over year. Net revenues up 9%. Transaction margin dollars, which has been kind of the one of the few bearish spots to point at for PayPal, was up 4% for the company year over year. Operating income was up 17% year over year for the company. Operating margin up 98 basis points to 15.2%. As far as their net income, that raised 12% year over year. And keep in mind, these are GAAP numbers. These are generally accepted accounting principles. You can't pull any tricks and say, well, take out this and take out this. No, this is GAAP basis. This is as true gets. EPS on a diluted basis up 18% for the company year over year. Net cash provided by operating activities up 64% year over year for the company. If you want to look at the non-GAAP basis, on an FX neutral basis, net revenues were up 10%. If you want to look at net income on a non-GAAP basis, 20% up year over year. EPS on a diluted basis, 27% up. Free cash flow up 76% year over year. Adjusted free cash flow up 86% year over year for the company. Absolutely phenomenal. Now, their guide came in sleepy, right? Guiding for 6.5% to 7% net revenue growth on an FX neutral basis. Here's the deal. They sandbagged this last quarter. They're probably sandbagging that one as well, right? Probably. That's just my guess in regards to this whole situation, right? Now, when we look a little deeper here, we're going to find that PayPal's balance sheet looks very good, very healthy. Total current assets, almost $64 billion versus a little under $50 billion in total current liabilities. So we're about $14 billion in the plus there. And then if you look at total assets versus total liabilities, close to $21 billion in the plus difference there. So PayPal's balance sheet looking healthy, wealthy, and stealthy. If we look at the income statement, it was a B-grade income statement here. Revenues about $7.7 billion versus just over $7 billion in the same quarter last year. Transaction expense was one of the few, I thought, down spots. $3.9 billion versus about a little under $3.3 billion in the same quarter last year. Transaction and credit losses, they brought that down substantially year over year. You would think, if anything, for that would be up, right? Nope. Customer support and operations, very impressive. They brought that down. Sales and marketing brought that down. Technology and development, they spend a little bit. Alex Chris wants to spend some. G&A, they brought that down. And then they got a one-off expense there, right? So operating income, $1.16 billion versus a little under $1 billion the same quarter last year. Income before income taxes, $1.2 billion versus less than $1.1 billion same quarter last year. Net income, $888 million versus $795 million the same quarter last year. Diluted EPS, 83 cents versus 70 cents in the same quarter last year. Very impressive. Now, if you check this out here, this is extremely important. Extremely important. On a sequential basis, they just grew active accounts. It has been quite a while since PayPal grew on a sequential basis active accounts. And they grew them by about 2 million. Is it some crazy number? No. But the bottom line is they grew active accounts on a quarter-over-quarter basis. That's huge, guys. It's been a long time since that has happened. So that means whatever Alex Chriss is up to, which he's up to a lot, is starting, keyword is starting to work. Now, that leads me to the conference call. That's where I was a little shocked, just to be honest, okay? You guys got to listen to that first 15 to 20 minutes of the conference call. It was impossible, literally impossible, to not walk away impressed by that conference call. Here's the deal. Alex Chriss, first off, sounded like the numbers sucked. I don't know other way to put it. He made it sound like this is I don't want to say disappointing, but like he laid it out like this is just a start. Like, this is no big deal. I'm looking and I'm like, this is pretty impressive, dude. Like, I like this net income we got here, especially when I own a stock here that has a forward P of 12 on it. It's not like this some crazy high valuation name that has a forward P of 55. And I'm like, oh man, we got to come in with insane growth. They're growing bottom line at double-digit clips. They're growing EPS at double-digit clips. This is very impressive. I'm very impressed. The revenue looked great, 9% year over year. Total payment volume, TPV, up 14%. I'm looking at this saying, let's freaking go. And he's just like, just makes it sound like, no, this isn't even like, the gist of it was like, nah, this is nothing. Just wait. You know, he views this as kind of like still down times. He calls it transition year. I'm looking, I'm like, dude, we're transitioning pretty freaking good. He keeps calling it transition year. He's like, this is early innings type stuff. We have so much work ahead for where we're going and what we're doing. And he laid out the whole roadmap. And I'm just listening to him go point after point after point on what they're up to. And I'm like, dude, this is freaking awesome. Like, I love it. I love it. Don't be satisfied. Don't be satisfied. I love it. And so, like, I challenge you guys, listen to the first 15, 20 minutes of that conference call, right? Do it over the next week or two. Do it on 1000xstocks.com if you want. And you'll be pretty amazed at what you hear. Now, my Mag 6. So 4 of my companies I've reported. How am I feeling about these companies? My Mag 6, these are companies that are 6 figures or more in the public count, right? Meta. I walked away from their earnings more bullish on Meta than I went in. Tesla. I walked away from Tesla's earnings the same. Probably about the same, roughly. I don't think I'm more bullish or less bullish on Tesla. Pretty much everything, I already know everything that was going to happen, okay? PayPal, as far as what the business is doing in the future, right? PayPal, I walked away from that one more bullish than I went in. Amazon, walked away from that one more bullish than I went in. Elephant Palantir still are to come. I'll be live streaming Palantir's earnings on Monday, okay, on Twitch. So overall, I'm pretty pleased overall. Now, the important thing I got to explain to you guys is only the strong survive. This is we are going through still an inflationary environment, right? The consumer's been hit bad. We've basically, I think we're kind of like in a borderline recessionary time, and we've kind of been flirting with this time for quite some time, right? And you're seeing a lot of companies' earnings where a lot of these big companies are just reporting very disappointing numbers. You look at a Southwest Airlines, how bad their numbers were, right? Caterpillar numbers were not even impressive to me. I was like, how's that company? That company should be like beautiful right now. And Caterpillar was even disappointing. You look at a lot of these big dog companies. There was others that reported last week that I went through their income statements. I'm like, this is just not impressive for a lot of these big companies that are significant, right? And so only the strong survive. And, we've been able to have so many people in the private group over time have such success in there. And this is because I teach everybody in those course curriculums exactly how to identify failures, successes. And you look at my companies and you're like, how are my companies reporting such phenomenal numbers, right? How are those business models getting in such a stronger place? You look at my companies, just look at the companies I reported, just in the past few days. Look at Meta's results. Absolutely phenomenal. You can't say anything bad about those. Look at Amazon. Look at SoFi. Look at these companies. Look at my stocks. Look at PayPal. Like, these are the companies that are freaking doing it, like, well. Their fundamentals are increasing dramatically. Their revenues, their bottom lines, everything you look at with these businesses. And it's like, how do I do that? I know what I'm fucking doing. Oh, shit. I don't mean to cuss, man. I know what I'm doing. And then you look at these other companies that are reporting such disappointing numbers. And you're like, it's because people are finding stocks that they don't really even know what they're doing. They don't know how to grade income statements. They don't know how to grade balance sheets, cash flows. They don't know how to figure out if they're getting ripped off on a stock or they're getting a great deal on a stock. And ultimately, in the end, they're buying into companies that have business models that are failing, revenues that are going down, earnings per share that are going down, net incomes that are going down for these companies, right? And then you look at my companies and it's like revenues going up, margins going up, profitability going up, earnings per share going up, net income's going up, up, right? So, all I'm saying is probably apply to join my private group, pin comment down there. You're going to get way more from it than I'll get from it. There's no question about that. And a lot of people, want to like put off like, oh, I don't need to be in Jeremy's group. I know stuff. And then they find their business models are failing and they're like, damn, I wish I freaking knew what I was doing. Sometimes you got to get smacked in the face before you realize you don't know what you're doing. And then you start taking things a little more serious and you realize, oh, I should have done this a long time ago. Appreciate y'all joining me as always. If you're looking to apply, join a private group, that will be the pinned comment down there. Much love and have a great day.